Now we're going to start getting into more granular details that will help you understand how to invest in the vegan economy and really how to become a better investor overall. So, what are we really doing when we invest? What we're doing is we're taking a very liquid asset, cash, and converting it into another asset, in this case, shares of stock in a company. And as we mentioned earlier, in the feudal era, there was really no liquidity at all. The kings and the lords really owned everything, and it wasn't like there was a free trade in any of the assets, if it was castles or land. And the only way to acquire those assets was through violence, through war. And then the rest of the population were serfs, and they had no hope of attaining assets unless they themselves became violent. So capitalism was a step away from violence in that framework, and the idea that the merchant class could now look at these assets as essentially a merchantable thing, like, for example, housing. There's a housing market, so there's a certain level of liquidity to a house as an asset. And until 1933, capital assets in the form of companies, companies became viewed as an asset class, and there was free trading in that asset class. With the Securities Act of 1933, the free trading of assets basically came to an end. And the capitalization market was divided into two parts. One was the public exchanges, and the other were private transactions between people at the top end of the wealth class. And so Western culture has pretty much struggled under this kind of legal framework for almost 90 years now. And as we discussed again in earlier lessons, that new laws that were created in 2012 and that have gradually become part of our legal framework through the development of rules and then, making those rules active. Now we have a fair amount of free trade in assets again. So before 1933, you could start a company like Ford Motors or General Electric by raising capital from the general public and trading those shares on exchanges. So that gave both access to the broad capital market as well as liquidity. After 1933, raising early rounds of capital was pretty much off limit in terms of raising from the public. So this meant that only the wealthy class really got to decide which companies were going to be formed and which ones not. And as a result of that, if you imagine you're a wealthy person, you're not about to invest in something that is going to destroy your own wealth. And that's been a really interesting challenge. This is why the U.S. economy and so many of the other westernized economies have become more and more top-heavy, because the idea of disruptive disruptive companies that are going to really dynamically change the economy, that really became only the prerogative of the wealthy. Now, we had this phenomenon in Silicon Valley with the creation of so much wealth through employee stock ownership in companies that had explosive growth. So you had kind of a semi-radical group of young, wealthy people who didn't have such a foot in the established wealth classes. And as a result of that, we got very highly disruptive companies like Amazon, which put in thousands of smaller businesses out of business. Same time, it created thousands of new types of businesses, the Amazon resellers. But there's a radical reshaping of really now the global economy as the Amazon style of business has been replicated in all the major economies of the world. But the choice to whether Amazon was going to get enough seed capital or not was left up to the very wealthy. But there you end up getting more almost like an East Coast, West Coast dichotomy. And so the West Coast has been seen as the more, people are more willing to disrupt the economy because they profit from that and they lose less from that. So, I mean, this still looks at investing as kind of a zero-sum game. And we have to really look when we're looking at veganism. The companies that are practicing animal agriculture are incredibly wasteful. They're really not profitable at all. If it weren't for government subsidies, that allow them to pollute like mad, destroy ecosystems, the kind of subsidies to GMO agriculture that feeds the livestock. If all that went away, they'd go out of business. So really, when we look at the animal economy, it's really much more a state capitalism. It's much more kind of Chinese style, top down, government decisions about which of those companies is going to win or lose. Of course, the challenge is it's not, benign politicians that are somehow trying to make these decisions for the good of the culture. What's happened instead is that the people with established power are holding the governments of the world captive and using them and their taxing authority and their regulatory authority to enrich the corporation. So we have really a global corporatocracy. That is the new government that we have. And yet inside of this framework, as I mentioned, we have these new rules and laws that allow average citizens like us, when I say average, that's a mix of wealthy and non-wealthy. About 1 in 10 American adults is a millionaire. So when I say average, that includes quite a lot of wealth. But again, only about 1% of the investor class ever really gets to make a decision about what kind of companies are founded. And so now with these new laws and the vegan launch model and in community, we can work together to decide which kind of companies we want to launch, and companies that serve all classes, not just the wealthy class. But what I'm saying is that actually, if some of these animal industries were to wake up and go vegan, they'd become more profitable. I may have mentioned this story before. When I was young, the cigarette companies were regulated that they could no longer do television advertising. Well, oddly, when they were forced to stop advertising, they actually became more profitable because that money was just a waste. So balance sheet wise, a savvy investor would really be looking at these companies and saying, well, we should buy them and veganize them, get rid of their unproductive assets, which is the animal production side. And what do they have of value? They've got distribution channels, they have brands, they've got employees. And veganizing these companies would actually free up a lot of capital and energy. So out of the 1933 Securities Act, we ended up now with liquidity being pretty much the monopoly of the big exchanges. Back when this was formed, the New York Stock Exchange was in existence. There were other exchanges, one called the Amex, American Stock Exchange, and the NASDAQ grew up later. And, so now most of the world's liquid investing in companies is in these two major exchanges, the NASDAQ and the New York Stock Exchange. And there are a variety of smaller exchanges all around the world. So the total wealth in dollar denominations is 100 trillion globally, again, with the majority of that in the New York Stock Exchange and the NASDAQ. But what we have is like a black hole. And so one of the major risks of investing in a startup is that there's really, for the 90 years, there's only been two paths for the investor to be able to reconvert that asset into currency. And that was either a merger with a bigger company for cash, or exchange with their liquid stock, or going public. So again, this kind of path has really constrained the kind of companies that we can create. So the lack of liquidity until the NASDAQ, like at the NASDAQ, a company has to have a $50 million valuation, and really that's too small to trade with all of the attackers, the short sellers and all. So you have this huge gulf of liquidity, and this makes it very unappealing for people to invest in truly meaningful companies that can make a difference. And that's why only about 1 in 200 vegan companies is getting any capital today, because the only ones that get funded are the ones where the founders can, where the founding investors can envision an exit to existing wealth pools. What are existing wealth pools? The status quo. So there's very narrow, and it's gradually broadening. But gradual is not the rate that we need this change. So yes, the tastes are gradually broadening. As older generations die out and they give their money to the younger generations, they're more vegan. But these same old bad investing habits have been implanted in the vegan investment community, and because of all these practices that developed from the legislative prohibition on liquidity. Well, again, those liquidity prohibitions, bit by bit, are being dropped all around the world, and we have something called secondary markets, which mean that most vegan companies, if they can get a little traction, they can begin to have controlled trading of their stocks on secondary markets, and these already exist. So this now creates another liquidity path beside just basically buying and holding forever and praying, or the wealthy being able to exchange with other wealthy people, or mergers, or going public. So the idea that now we can create much more granular valuations of companies as they grow really gives us the opportunity to do all kinds of businesses that are not necessarily suitable for mergers and acquisitions. And that's good, because we want to replace these old companies with a new paradigm of veganism. And to the extent they want to come along, that's great. But the whole old way of doing things, of treating animals as slaves, as commodities to be exploited, that whole old paradigm is killing the planet and killing humanity. And we have to, more and more people are waking up to that fact, and we need to create many, many more jobs, many more economic opportunities, so that people can gracefully leave their old bad habits and do something new. That's why the easy thing is to go vegan yourself. That's the easiest thing we can do. But it's also, in a way, the hardest thing. And vegans often struggle with being now, social, not feeling like they have a social group that understands the paradigm. So we need to make it progressively easier. And now that we have basically seamless liquidity from startup onwards, means that the risk to investors is moderated quite a lot. It's still going to be incredibly risky to invest in startups. And you'll see the chart that we put in the lesson plan for this lesson, the different quadrants of risk. So investing in startups is always going to be high risk with the potential of high return. When I say high risk, that means the chance of losing all of your assets, all of your investment, is very high. These days still, if you invest in Wall Street stocks and Standard & Poor's 500 indexes, the risk of losing all your capital, it seems moderated, at least for now. And I think, that's kind of a given. I think as the world wakes up to climate change and all of the other, mega events that are happening, we can't really say how risky investing in retail stocks is today. But again, those risks are moderated. Lately, we've seen action by the Chinese government to take over and control their most successful companies. And so that's become a new risk factor, the idea of government intervention in the free market. That's another risk factor to the valuation of companies that has to be taken into consideration now. So whenever you're investing, there's risks and rewards, but the one risk of no liquidity, the gulf of liquidity until the major exchanges, day by day, that risk is being relieved. And that really, when you think about that, that just opens up the creativity. Later in this lesson plan, we're going to analyze the Beyond Meat stock chart and their early capitalizations, and just show where the opportunity lies now that liquidity is available to the general public, who can also now invest in startups. So um, I look forward to getting into more details with you. And this is the part where people who really want to change the economy, we need to understand these principles and concepts and not keep doing things the old way, because the old way only leads to more of the status quo, or let's say marginal gains. And marginal gains are better than no gains, but if we look at the scale of the problems we're facing and design backwards from that, we can see that marginal gains are not aligned with the true transformation that our culture needs in order to get through the climate change and health bottlenecks that we're in right now. So again, thanks for watching. I look forward to seeing you in the next topic.